Good evening, everyone, and welcome to the Henry Schein Dental Academy webinar series. My name is Adam, and I'll be your moderator. Dr. Tom Snyder is back with us for another webinar. Tom is the Senior Director of Henry Schein's Professional Practice Transition Team, and tonight he'll be covering how to create an effective partnership. If there are any questions, please type them into the Q&A section of your control panel, and we'll reply via email within 2 business days. Henry Schein is not offering CE credit for viewing or attending this presentation live or on demand. And this webinar is sponsored by Henry Schein's Dental Business Institute. Tom, welcome back.
Good evening, everyone. Thanks for joining me this evening. We have a very fast-paced program tonight about creating an effective partnership. Got lots of information to share with you, so let's get started. Tonight, we're going to learn about various business entities when establishing a partnership agreement. We're also going to have you understand several ways to structure a partnership buy-in and buyout. And most importantly, we're going to learn how partner income can be shared. Well, then we'll also address key issues that must be included in a partnership agreement. For those of you who graduated from dental school 15, 20, or 30 years ago, the predominant form of dental practice was a solo practitioner. And many of you decided to become a dentist because you wanted to work alone. Well, generations later, that has certainly changed, and the statistics support this premise. If you look back in 2004, you'll see about 63% of all practicing dentists were solo practitioners. And then in 2009, it dropped below 60%. 2014, hovering around 50%. And now, as of 2018, approximately 50% of practitioners are solo practitioners. We don't have any more current data, but I would not be shocked that when it is released by the American Dental Association's Health Policy Institute, it's going to be in the high 40s. It just is the way the trend is going. And let's kind of drill down those statistics a little more. Looking at that 50% ratio, the most recent data shows that about 55% of male dentists are still solo, whereas only about 41% rounded of female dentists are solo. And since right now, if we look at the number of female and male dentists, we're about at an equal pace. So it's fair to say the numbers will continue to go down. Another interesting statistic is about age of dentists. And in 2010, the ADA reported that 28.6% of dentists under the age of 35 were in solo practice. And 9 years later, only 1 in 4, 25% under the age of 35 were in solo practice. So obviously, generationally too, more dentists would rather work in groups, whether it's their own practice or whether it's for corporate group practice. That's the trend as we see it, and it will continue for sure. So I'm sure there's lots of things swimming around in your mind about why you attended this webinar tonight. And you're thinking, obviously, about forming a partnership. So let's look at some of the things that you should be considering if you haven't already done so. First of all, how long do you want this partnership to last? Many times I have conference calls with doctors who are in their little mid to late 60s who want to form a partnership. But when I ask them, how long do you want it to be in existence? They say, well, just a couple of years. And what I do is I try to talk them out of it because I really feel that if a partnership is only going to last 3 to 4 years, it could be problematic, notwithstanding the fact that as you're going to understand pretty soon, there's a lot of things to consider, lots of technical issues involved in partnership formation, notwithstanding all the agreements and costs that need to be undertaken in this endeavor. So I usually like to see partnerships last at least 5 years. That's been my experience in my career. And of course, what's the alternative? Well, what I usually tell doctors, if you're thinking of a 3 or 4 year partnership, why don't you consider a deferred sale? And we'll cover that in detail shortly. So I'm sure you're also aware that your compensation may be reduced if you become a partner, particularly if there's a reduction in your clinical schedule. And we'll chat about that shortly. Obviously, if you're a solo practitioner, you were the boss for 10, 15, 20, 30 or more years. Now you have to have someone else who has to participate in your decisions. So that's why sometimes doctors will say to me, well, I want control, so let's have a partnership that's 51-49 in my favor versus 50-50. Well, if it's a 51-49 in your favor, that doctor is nothing more, in a sense, than a glorified associate who's paid you a fairly good sum to become a partner. There are ways you can get around that control issue as far as decision making in your shareholder or operating agreement. So there is a way to counteract that. Our preference, obviously, is 50-50 if that's what your desired outcome is going to be. Another thing you have to consider is how profitable are you? Are you economically healthy? Because obviously, you've been getting all the income. If you're the owner, even if you had an associate, you should be making a profit from their efforts. But nonetheless, now we're going to be sharing more income. And so is there enough cash flow there to make it worthwhile? Because obviously the doctor is going to either have to borrow money or pay you a fee to become a partner. And they're always going to look at, am I better off being an associate or being a partner? So that can weigh heavily if your practice has a high overhead. How about your candidate? Obviously, most people are going to bring a doctor in who's been with them for some time as an associate, whether it's a year, 2 years, or even more. Have they shown any interest in practice management, in the systems in the practice? Are they interested in dealing with staff? Do they have any ideas about marketing? If you're weak on the SEO side, can they actually help you to do more things via the internet to build your practice? So these are things you're going to look for, because you want to have a partner who's not just going to share your clinical responsibility, but your managerial and marketing activities as well. More importantly, does your candidate have a good relationship with your staff and other doctors, if there are other doctors in the practice? And of course, have you observed them in patient care relative to dealing with patients? So there's a lot of subjectivity to a degree when you're weighing whether or not you want this person to be your partner, that are not just all related to the finance side of it. If your spouse has been involved in the practice, what will be his or her role in the future in a partnership? That needs to be addressed, because I've seen situations in my experience where spouses can get in the way and things don't always work out as planned. Now, it goes without saying, if you're going to form a partnership, there has to be an adequate size patient base. And this is more for a general practice, where we're looking at 1,100 to 1,300 patients per full-time doctor. Pediatric dentist may be a couple of thousand, for example. A prosthodontist could be less than 1,000. And other specialties, it's really based on referrals. Orthodontics, usually it's based on the number of case starts, things of that nature. But nonetheless, you've got to have an ample size patient base for this partnership to really have success. Now, if you plan to reduce your schedule because maybe there aren't quite enough patients to support 2 people, or are you considering reducing your clinical schedule because you've been working 4.5 days a week and you'd like to work maybe 3 days a week and have a nice long weekend? Well, what does that mean in terms of production shifts and income as far as your income? We mentioned before that if you start to shift patients to the other doctor based on the partnership income formula that we'll be talking about later, that could have an impact on your overall compensation. So is there enough there to support that partner's production? So what do we look for? Typically, in the general practice, we're looking for $40,000 to $45,000 of collections to really make a partnership work because of all the economic considerations. Now, obviously, this is based on your fee schedule. So based on where you're located in the country, that number may be a little higher or a little lower. Specialty numbers will vary all over the map. But suffice it to say, it's got to be a number that when you crunch the numbers relative to the partnership income formula, will that associate be better off economically than they were as an associate? And that's really what the associate or partner candidate is going to consider. Is it worth me to pay $500, $600, $700, $1 million to become a partner in terms of what I was earning? And one of the problems I found in my career is when we have an associate who's been with the practice for numerous years, and now they're generating $250,000 to $350,000. They look long and hard at whether or not they want to borrow a considerable amount of money to become a partner. They may just like to stay in their position. So sometimes high producing associates can work against you as far as them being the candidate that you want as a partner. Now, we talked about before, if we don't have enough patience to go around to have a successful partnership. So one of the strategies we can consider is a deferred buy-in. So we're going to look at this in the context of a 2-doctor practice. So we assume there's an insufficient patient base for 2 partners. And obviously, the production of the associate can't support an immediate buy-in. So what do? Well, we create a baseline practice value at the outset. And then you may say, well, I'm giving up value. Why can't I have this value done 2 years from now? Well, that wouldn't be fair to that associate. We want that associate to work as hard as they can, particularly if they are good at marketing and they can help build the practice. They certainly do not want to pay for the production that they brought in based on activities that they've engaged in on their behalf. However, you still are going to make a profit, because if that associate is doing well, you're getting a profit margin off their efforts. So some of the value you gave up, you're going to get in current income during the employment phase. So we update the valuation, however, at the time of the buy-in. But how do we do it? Well, we look at it this way. If, let's say, a practice was worth $800,000 today, and the associate is going to buy in at the target point, which we'll talk about in a second, in 2 years. Well, it would not be fair for you to sell that practice for $800,000, but it would be unfair for you if you were going to revalue the practice. So what do? We adjust that $800,000 for time value of money or inflation. And how do we do that? We refer to the Bureau of Labor Statistics inflation calculator. And if you were just to go to bls.gov, you'll see on the homepage an inflation calculator, and you could just type in numbers, type in $500,000 in 2018 and hit calculate, and it'll tell you within 2 months of what that money is worth in today's dollars. That's how we handle it. That's the fairest way. Again, we're not trying to increase anything. And of course, during that period of time, if you bought any capital equipment, that would have to be factored into the value as well. Or, as some doctors have done because of COVID, there was a record sale in your area and you purchased the records of another doctor, that additional income would be factored in, because it would be unfair for that not to be considered. So those adjustments would also have to be made. Now, when we do a deferred buy-in, it's really a numbers crunching exercise to the extent that we prepare a pro forma, which is basically a projection of future revenue and expenses for the practice. And we do it by provider. So we look at what the current associate's production is, and we make assumptions about their growth rate, and we set goals. And these goals are economic goals for the associate, and you to clearly see that the practice needs to generate A, a certain amount of total revenue, and B, more importantly, the associate is able to achieve a certain level of performance. And that time frame can be anywhere from 3 to 6 consecutive months. And once that happens, the buy-in is initiated. However, we don't wait until that happens. We actually feel you should pre-negotiate the terms and conditions of your partnership as this process takes place. So now you're ready to begin your partnership. And let's assume many of you are still a solo practitioner. If you're already incorporated or you're a single member LLC, which we'll chat about, then that's not as critical. So one of the first things that I do when I consult with doctors on partnerships is I have a conversation with your CPA, because they understand your overall financial history, they file your tax returns, they understand the different types of business structures. So I have a conversation with your CPA to determine, if you are particularly a solo practitioner, which business entity would be best for you to adopt. So what are the choices? One, very commonly, is an S corporation, a professional corporation with what they call the sub S election. C corporation, you'll see that's in red, because typically we don't form C corporations now. C corporations were very popular. In fact, some of you attending this program tonight may have had a C corporation for the last 15, 20 years for pension plan purposes, and you never did convert to an S Corp, but nonetheless, you're a C Corp. So we'll talk a little bit about how we handle that from a buy-in point of view. But typically, from a current standpoint, we don't see most accountants recommending a C Corp formation. Many accountants also might recommend to you an LLC or a PLLC, which we're going to cover in a minute. And finally, a general partnership, which quite frankly, years ago was the general method for partnerships, where there's a lot of, there's general liability, joint and several. So those are not usually formed, in the exception of a 3-entity relationship, which we're also going to cover tonight. So what are some of the SCorp features? SCorp is called a pass-through entity. By that I mean profits and losses are passed through to you personally and taxed at your rate. With the recent tax law a few years ago, there was a section in the IRS code called Section 199A. And that meant there was going to be a certain tax break where there's a 20% reduction in net income with phase outs. And the phase outs for spousals at the baseline period were $315,000, and for single doctors, $157,500, which has been inflation adjusted. Nonetheless, not to get into the weeds here, because obviously that's something that your CPA can explain to you, but those are the things that he or she will contemplate when they make these decisions on what your business structure should be. However, if you have an S Corp, and if you already are an S Corp, you understand that you have to have a reasonable salary before you get that reduction. And what is a reasonable salary? Well, the IRS doesn't really come out and tell you what they think it is in case they audit you and say, well, gee, Dr. Snyder, this is an unreasonable salary. You had $500,000 in profit and you paid yourself a salary of $25,000. With the rest of that money flowing through to you personally, they might disallow that, and that could be a problem. So typically, you have to look at it this way. If you're a solo person, now you're forming this S Corp before you bring your partner in, what would you pay an associate? And that's kind of how you have to think about what a reasonable compensation should be. So when you have an S Corp, when you file your tax return, the tax return is called an 1120S. You file a K1. And obviously, when you file your K1, payroll taxes are avoided, particularly the Medicare component. However, the IRS has been and will continue to look at professional corporations, and they're looking for K1 abuses, meaning the example I gave previously of a very high income with a minimal salary. That could be overturned. Now, in an S Corp, the pass-through income, or what's called a distribution, must be based on ownership interest. What that means is if there is $500,000 of profit and there are two partners, each doctor has to report $250,000. One can't have a higher level of number because that could force an audit and a disallowance. And the disallowance could be forcing you to become a C Corp, which wouldn't be a good thing. Now, the other pass-through entity, which is has been growing in popularity over the last number of years, is limited liability company or a limited liability partnership, and in some states called a professional limited liability company or a professional limited liability partnership. Now, what are some of the features? Well, one thing, unlike the S Corp, for the most part, legislation is very state specific. As a matter of fact, not all states allow a dentist to use an LLC as a practice entity. They require you either to be a C Corp or general partnership, or of course an S Corp. One of the nice features about an LLC is that it does provide the same liability protection as a PC, which means your personal assets are protected. However, it doesn't shield you from any malpractice issues should they arise. And that Section 199A deduction also applies. So therefore, as a LLC member, you do receive a guaranteed payment, and that has to be reasonable as well before that 20% reduction is taken. In an LLC, the owners are called members. In an SCorp, the owners are called shareholders. So difference there. Significant difference here is that distributions can be allocated differently than the ownership interest. Meaning, if you had two doctors and they're 50-50 members, in an LLC, you could have a higher distribution for one member than the other, and it could be based on production differential. That cannot be the case in an S-Corp. So some doctors like that feature, particularly if it's a younger associate and the differential in production is dramatic. Maybe that's the direction people may take. Again, it really is dependent on what your CPA, has to say about the matter. Now, in an LLC or an LLP, typically you're not paid a salary. I mean, you could opt to have a salary paid, and we find that some associate doctors who've been used to getting a W-2, when they become a partner in a limited liability company, I've seen where their accountant says, let's continue paying you a salary. That's okay. But by and large, the majority of the people will pay themselves a guaranteed payment. It's paid as a draw. And one of the features that many solo practitioners like about an LLC is that you pay your taxes on a quarterly basis, unlike the weekly, monthly payments you must make in an S-Corp because of payroll taxes. So that tax-paying behavior sometimes drives the decision for a doctor to say, well, I'm used to doing this for the last 20 years. Let's keep it that way. So we're going to file our taxes on a quarterly basis. Any personal items, which we'll talk about in a little bit, on income sharing, are paid to the practice and can be charged to the member's draw. So that's kind of some of the legal things and why it's so critical to have your accountant involved in the beginning. And I spend a lot of time with the accountant, making sure that they've done their correct analysis and make the proper recommendation. Excuse me. So what are the major issues in partnerships? Obviously, is we're going to learn the buy-in. Buy-in has some characteristics and features that a buyout may or may not have, but needs to be addressed. And of course, operational issues rendering to how are we going to split income? How do we handle decision making? How do we handle bringing in other doctors into the practice? What happens if something happens to one of us? What happens if someone leaves prematurely? Those are operational issues which we're going to chat about shortly. Now, there's different types of partnership buy-ins. Many doctors want to have a 50-50 partnership, particularly an associate who's been with you for a while. Chances are they probably wouldn't be too thrilled, one, about being a 49% partner, and two, buying into your business over 3, 5, 7 years, especially if they've been there for a while. They're probably producing very well, and they're ready to share in your success. So they will put pressure on you, and rightfully so, to become a 50-50 partner. Fortunately, banks are well aware of the growing number of partnerships, so they are very amenable to funding a partnership buy-in with cash. And so the bank will place a lien on the practice, and that's something the owner has to understand. But the good news is the owner is not going to sign personally, but the assets of the business are pledged as collateral because the banks have to have something, because it's really an unsecured loan in all good sense of the matter. Now, as an alternative to a immediate 50% partnership, you could do a phased buy-in. This is particularly for less experienced doctors. Maybe they're lower producing. They can't afford, nor do they want to go to the bank. They'd like to buy in gradually. They're very happy with that. They just want to have an equity position, and it's not critical for them to be 50-50 right away. If it takes them 3, 4, 5 years, they're okay with that. So a phased buy-in may be the proper alternative to select. Typically, the phased buy-ins are financed internally. Now, when you do a phase buy-in, one of the things that many advisors who counsel the Dr. Junior or the associate becoming a partner will recommend a lack of control discount to the goodwill value, meaning that if I'm not a 50-50 partner, why should I pay top dollar when I don't have control? Because my partner can make decisions and I have nothing to do to stop them. I can always try to sue, but that's not a practical or a realistic alternative. So typically, lack of control discounts are considered oftentimes by the advisors of the Dr. Juniors or associates who are buying in. So let's look at some of the buy-in structures, because there's only so many ways to do this. The first way, this relates to doctors who are a corporation. LLCs are a little bit different. Fortunately, they're easier to deal with, but as you'll see rather quickly, because you're dealing with corporate stock, it's a little more complicated. So the first method is a stock sale, including goodwill. The second is a stock sale, excluding goodwill. Third is an asset sale requiring multiple entities. And I must confess, the last method is becoming much more common because many advisors for young doctors aren't too thrilled with options 1 and 2 and will push to move the transaction to an asset sale. And you'll see why that makes sense, particularly for the new partner. So let's look at option 1, the 100% stock sale. Very classic, traditional. Most advisors for the selling doctor or the founding doctor are going to recommend this because their client would get a complete capital gains treatment. And I'm sure most of you, if you were selling your business interest, would like to get capital gains treatment. You know, currently at the tax rate, it's great. Who knows where we'll be in 2022? All things can change if the tax rates change and capital gains are almost the same as ordinary income. It'll be interesting to see how that plays out. But today, capital gains treatment is still favorable. And that's why some doctors are trying to get their deals done this year, just in case there is a change in 2022. We don't know that, but it's on the table, of course. Now, the traditional stock sale has the least amount of IRS scrutiny because everybody's paying their tax in the way the IRS likes it to be handled. However, the person who doesn't get a good benefit to a 100% stock sale is that purchaser or Dr. Junior. So oftentimes, and we think it's appropriate, I always counsel doctors when they want a stock sale that be prepared to lower the value that they're going to be paying for. Because as you'll readily see, it's a lot more expensive for that new partner to pay for stock if it's 100% allocated that way. And why is that so? Well, the purchaser will pay income tax on all compensation earned, all compensation. The stock purchase is not deductible, so that's not such a good thing, is it? And it's also paid with after-tax income. It's similar to a mortgage payment. So let's take a look at what that really means. Let's assume the stock was valued at $500,000, and let's say they went to the bank and they borrowed the money, and the loan interest over the period of the buy-in is $94,000. Let's say that the junior partner's tax rate is 32%. So what that means is we take the reciprocal of that 32, which is 0.68, divided into the 594, and that's what it's going to cost. It's going to cost that doctor about $874,000 to pay for a $500,000 interest in a practice. So you can readily see why advisors for the junior partners aren't too thrilled with a stock sale when it's allocated that way. Let's look at option 2, stock sale excluding goodwill. You may recall, if you have attended one of my webinars on practice valuations, that typically in a dental practice valuation, whether it's for a specialty or for a general practice, approximately 70 to 75% of a practice's value is goodwill, the balance being tangible assets. So when we look at this particular method, what happens is that the tangible assets are usually allocated to stock, and that's paid for in after-tax income. And as I said, it's usually less than 25% of the practice value. Sometimes it can be higher when there's a lot of new equipment and technology. And of course, this particular purchase of the tangible assets can be paid in cash or in a promissory note. Now, when we get into this particular strategy, oftentimes we use a compensation shift. And what does that mean? Well, the seller is going to receive additional compensation for goodwill, which is the majority of the value. The problem in a compensation shift, and what does that mean? Compensation shift means we're shifting income that's been generated and earned by the Dr. Junior to Dr. Seller or Dr. Senior. So the seller or Dr. Senior reports that as ordinary income, not as a capital gain. So all of a sudden, that particular outcome would not be too favorable to you if you were the recipient. So what happens? Well, we think it's fair that if we look at the differential between what you could have been paid had you sold stock at a lower tax rate and what your current tax federal and state rate is now, the difference between that would be added to the payment. And if it's financed internally, which it typically is in a compensation shift, there's interest that should be added on because effectively it's kind of like a loan because you're giving them the ownership interest, but they haven't really made the full payment. So that can vary anywhere between 18 to 25%. However, for the young doctor or Dr. Junior, they're still probably better off making a higher payment than paying for it in after-tax dollars. And again, this is where the accountants for both sides will go back and forth and look at this piece because it's very, very important. Again, we want to be fair to both parties, but remember, for Dr. Junior, if they, let's say they were going to earn $300,000 and there was a shift of $100,000, that would lower their tax rate. And let's take a look at what that would appear to be. So let's assume that the goodwill in this particular transaction for option 2 was $500,000. And now we've added a tax effect and interest of $135,000 because it's going to be paid for over time, right? And it's going to be paid for in 7 years. So what that comes out to be is, well, let's say Dr. Junior earned $300,000 and the annual payment over 7 years was $90,700. So Dr. Junior's comp would be $209,300,000. They wouldn't be paying tax on the 3. They'd be showing the $209,300,000 as their compensation. So you can see that's what a compensation shift does. Changes the dynamic of what doctors are generating in income. Option 3, and this is the one, as I mentioned before, is much more popular and being used, and I think you'll see why a lot of advisors prefer this method, albeit it's a little bit more complicated. Typically, this is an approach that's used when Dr. Senior already has a professional corporation. They're either a C Corp or an S Corp. So what happens is that Dr. Senior is going to retain their entity throughout the lifetime of the partnership. Dr. Junior will form a business entity, either an S Corp or an LLC. So as you can see, unlike some of the other particular methodology where it's a personal transaction now, and the partners are the doctors. Now the partners are 2 business entities. They are the ones that are truly the partners. And so what has to happen? Well, you need a third entity, an operating company that's formed as a third entity. It can be a general partnership or a limited liability company. And the operating company is the employer of all the staff. They pay all the direct business expenses for each owner. And so what happens is that Dr. Junior's entity will purchase an interest in the tangible assets from Dr. Senior's entity, And they will also purchase the personal goodwill from Dr. Senior or his or her entity. And it's extremely beneficial to the purchaser because they can depreciate the tangible assets, the entity can depreciate the goodwill, and interest payments are deductible to the entity. So again, a little more complicated, but it does accommodate particularly the new doctor, Dr. Junior. Also, we mentioned that the entity pays the majority of the operating expenses. All revenue then flows through the operating entity, meaning that this entity will bill the patients, process insurance, collect revenue. All staff, as I mentioned before, become employees of the operating entity. However, if the doctor already had, some associates now already have LLCs when they were employed as an associate because they were independent contractors in the relationship, and they may have some staff there who have some pension benefits. So we have to be very wary of pension law restrictions. Again, this is why you need good financial advisors to walk you through this, because there's a lot of technicality involved in these types of arrangements. Now, after all the expenses are paid, the profits will go to each partner and reported through their entities. And based on the income sharing formula, which we'll cover shortly, they will receive their income that way. If there are other related expenses that are kind of allocated to each individual, that partner's entity will pay for them. So we talked about before that with partnership financing, bank financing is readily available. And I mentioned before that no personal guarantees are required, and the practice's assets are pledged as collateral. Now, some doctors aren't too thrilled about that, so that's always problematic. And so, again, you can see once we get to the entity and the tax side, we have to figure out the financing side to make sure that both parties agree that this is how it's going to be done. Where we've run into some difficulty, where things get a little more complicated, is when there's any outstanding practice debt. And of course, if the doctor were going to retire all his debt from a cash infusion, there could be some potential tax consequences to the seller. So therefore, again, the accountant needs to be brought in to make sure if they were to receive cash for a buy-in and they're going to use that cash to reduce debt, will that be a problem? So we also worry about, well, what happens when the doctor comes in? If it was a stock sale and there's debt on the books, then that debt will also become debt of the buying in doctor. Now, also, you can consider seller financing, where you provide all or a portion of the funds for the partnership. If you're going to do that and become a bank, you should charge a fair interest rate. Typically, it's easy to find out what the national dental lenders are charging. And most times it's fair to possibly ask for an extra 1 or 2% because you're taking the risk of the transaction. So it's like points in a mortgage, the same thing. So you may want to ask for a little bit higher rate. And one of the features, if you're doing seller financing, is considered an installment sale for the Dr. Senior, and there are favorable tax consequences because the gain is reported in the year the money is received. Now, when we start structuring the economics of the buy-in, we also have to calculate the partnership value. Yes, admittedly, we did a practice valuation, but as you may recall, practice values do not include cash or accounts receivable. So if we want to make a clean buy-in, we may want to consider factoring in the accounts receivable. And if we do, we have to make sure that they're factored appropriately, meaning if we have some old accounts, their probability of collection isn't as high. So we need to do an adjustment and come up with what we call a net account receivable value. And then if there are any liabilities, we have to subtract those liabilities, and we come up with a net buy-in value. We multiply that by the ownership percentage, and as you'll see in this simple example, we come up with a number which will be what the new doctor partner will pay. So let's assume it's a 50% interest. Practice value is $1 million. The net AR after adjustments for, aged accounts, etc., it was $100,000, and we had $50,000 of liabilities. The net practice value would be $1,050,000, and since they're buying half of it, the partnership interest would be $525,000. So let's shift now to partnership contracts, because we need them to protect parties, to memorialize everything, all the decisions. Unfortunately, in my career, I've been involved in partnerships where they were done with a handshake. And it worked well for 10 or 15 years, but then an event occurred, could be financially related or whatever, and now they're scrambling to figure out how do we handle it, and there's nothing in writing. So hopefully you'll take the time and spend the necessary money to get this done correctly. So if you're going to have an LLC or a PLLC, you're going to have agreements called an ownership interest purchase agreement. That's the agreement that's going to memorialize what you're purchasing from the doctor. The operating agreement is the governing agreement, all the terms and conditions of how the practice is going to operate, how you're going to be paid, what happens if there's retirement, death, disability, admission of new people. All those things are clearly discussed in the agreement. And of course, if you own the building, you should have a properly prepared lease at fair market value. If you have a PC, your agreement would be a stock purchase agreement, which memorializes how you're purchasing the stock. The stockholder agreement, which is your governing document, which did the same thing as the operating agreement, with one notable exception. Since you are employees and you're receiving W-2 income, you will also need employment agreements. And of course, the lease applies to those who own the building. Let's talk about partner income sharing, because this can become a big issue and needs to be addressed up front. Everybody knows how they're going to be paid for the efforts that they make in the partnership. When we create the models, and we typically do spreadsheets to show our clients different ways of sharing income, we come up with a definition of what we call available partner compensation. And that's defined as the net practice revenue minus the practice's normal operating expenses. Any fringe benefits that would go to the partners will be included in available partner compensation. So let's look at the first method, relative production and distribution share. First of all, we determine what percentage of available partner compensation is allocated to personal production of the partners. We multiply that component percentage by the available partner compensation. So typically we start out with what we call 50% allocated to production and 50% to distributions, but it doesn't have to be that way. It could be 60% to production and 40% to distribution, or even higher. Or conversely, if doctors don't want to have as much pressure on production, it could be 40-60. So let's look at an example of how this plays out. We'll use the 50-50 breakout. So available partner compensation was $800,000. Production compensation was $400,000. The distribution allocation was $400,000 because we split it evenly. And we found that Dr. A's clinical production ratio that year was 55%, and Dr. B's clinical production ratio in that year was 45%. So how does the math work? So if we look at the production side of it, we take Dr. A, we take the $400,000, which is the allocatable money for production, multiplied by 55%. That comes out to $220,000. For Dr. B, we take the same 400 multiplied by 45%. That equals $180,000. We take the distributions of 400. Each doctor is a 50% owner, so they're split in half at 200. So in this example, Dr. A receives $420,000 and Dr. B receives $380,000. So that's the first method. Another way of doing it, and quite frankly, most of my clients prefer this method, it's a commission-based compensation. So simply, we start out establishing a monthly partner draw, similar to what you do with an associate. And you will be paid a commission on your collective production or collections. Typically, we see 35 to 37% for GPs and 38 to 40% for specialists. Those numbers can be anything you want. If you're a highly profitable practice, you can go higher than that. If your overhead's a little on the high side, maybe you'll go lower. Again, there's no right or wrong way. In the end, it's about fairness. So in this particular method, unlike the first method, in the first method, when we just looked at relative production, we didn't factor in any related expenses like lab, implant, ortho expense. You don't have to do it that way, but if you feel there is a disproportionate sharing of those expenses, then you'd want to make it just like an associate compensation, where you would include the lab, implant, or ortho expense in the commission-based compensation. Again, doesn't have to be that way. It's a personal preference. No right or wrong. It's just a matter of fairness, as I said before. So let's look at the commission payment with distributions based on ownership. Let's assume that Dr. A's commission was $210, Dr. B's commission was $180, and we go back to the same $800,000. Now we take their total compensation, which was $390, and it left about $410,000 to be split. So in this particular case, Dr. A has a commission of $210 and a distribution of $205. His or her total comp is $415. Dr. B, $180 plus $205, $385. At the end of the day, I'll be honest with you that the differential between these two methods are not dramatically different, but it's a matter of convenience, how you'd like to pay yourselves. Now, with the commission-based method, there's a distribution, as there is with the other method, because let's say we're assuming we're a corporation, or it could be an LLC. So distributions or bonuses are made according to ownership interest if you're an SCorp, or as I said before, if in fact you wanted to have a disproportionate sharing based on clinical production for an LLC, you could have your distributions allocated that way. Any fringe benefits are charged against the distribution or bonus share. And frequency is up to you, quarterly, semi-annually, or annually, based on what your accountant feels is best in terms of how you report to them and what they do for you. No right or wrong answer in terms of frequency. So that's the income part of how the partners are compensated, and that's going to be recited in your operating agreement or in your employment agreement and shareholder agreement. Another key element that needs to be considered is time commitment. What do I mean by that? Well, I always ask the question, what is the mandatory retirement age? That's the age at which you are required to sell your ownership interest in the business entity. So we have to establish an age. And I can tell you, when I work with younger doctors, their age range for retirement is 10 to 15 years less than what it is for doctors who are maybe in their 50s and 60s. So it's always interesting to see the time horizons each group has. But nonetheless, it's a time when you are required to sell your interest. But that's not enough, because in my career, unfortunately, I've seen abuses where doctors, rightfully as they get older, were very successful. They had a second home and they take a lot of time off. And even if they had a production-based component, they were still getting 50% of the profits, particularly if they were an SCorp, right? So that created a lot of angst with the doctors who were doing more work and spending more time. So we think it's fair to establish a minimum number of days or hours worked annually to retain partner status. So again, we go through this in our consultations to make sure everybody understands what's at stake, and we come up with the criteria. There's no right or wrong answer. It's really based on what the practice is doing, the number of days you're currently working, how you feel about that. Again, it's just something that needs to be considered. Additionally, we also sometimes consider minimum production goals, because if I just had minimum days or hours work, I could come in and do work. But what if I really didn't do 60% of what I used to do? Would that be fair? So again, we throw these things out for consideration to make sure we avoid problems in the future. Patient distribution. This may not apply to everyone here, but in some cases it does. So I'm going to mention it, that we discuss this. And in this case, the entity remains the trustee of all the patient records. And, we cite if there's a preference to provider, they're assigned to that particular doctor. If there's no specific provider request for a new patient, then equal distribution must be maintained. And I've even seen in some situations, referral to specialists are also demarcated as far as what stays in the office and what is sent to specialists. Again, points for discussion, doesn't mean they have to be included. Now, risk management, unfortunately, obviously, when we have partnerships, things can happen. People get ill, become disabled, they can pass away. So we need to have insurance mechanisms in place. So one of the first things people think about, well, if there's going to be a disability buyout, should there be any discount to value? Some doctors feel it shouldn't be. It wasn't their fault. They did nothing wrong. They got disabled, so it's full value. Others might want a slight reduction in the goodwill value, maybe 15, 20%, 25%. Again, it's all relative. There's no absolutes here. It's a matter of what both parties, or if it's multiple doctors, feel is in the business's best interest. What about the buyout terms? Is it a cash or is it financed internally? Typically, disability buyouts are financed internally over a 5 to 7 year period. If there are only two partners, we have what's called a cross-purchase agreement in terms of the different insurance products. If there's more than two partners, entity agreements are used for multiple partners. So insurance products for consideration, obviously life insurance. Fortunately, life insurance is relatively inexpensive, and you can get 10 or 20-year term at a pretty darn good rate. So typically, when we have situations where a partner dies, usually those deals are pretty well funded. When we have a disability situation, that's where things can get a little risky relative to the practice paying the majority of the proceeds for the buyout. However, doctors need to have personal disability. And even in the agreements that we have, we look at the personal disability coverage of each doctor. And why that's important is because if a doctor becomes disabled and they're getting a draw, should they get their complete draw for the first month of disability? Should that draw be reduced by a percentage for the second and third months? Or is it not affected? Because it's all about cash flow. Because if a partner is disabled and there's no replacement, the accounts receivable of that disabled doctor can hold up for a while, but they'll eventually run dry. So that's why we try to tie in the waiting periods for the personal disability of the partners with the compensation of a partner when they're no longer in the practice for a disability period. Office overhead is also considered, and disability buyout is a product, although admittedly it's not used that frequently. It's more applicable for younger partners because as you get over a certain age, I believe it's the age of 50, 55, premiums get very expensive. And what a disability buyout does, unlike life insurance, you can fund the entire value. It's just a matter of making sure you keep your value constant and keep your level of coverage constant. With disability, they don't pay 100%, and they don't usually pay lump sums. They give you payments over time for the disability. So it's not 100%. Again, something you need to discuss with your insurance broker if that product makes sense for you. Management responsibilities can become a sticky point of negotiation in partnerships. And what do I mean by that? Well, if the founding doctor was a really high producing person and a person who worked maybe on Fridays or Saturday mornings, did the payroll, did all kinds of work, And the other doctor who's coming in as a partner really just wanted to be a good dentist. Now we're partners, and I'm still working on Fridays or Saturdays. Should I get paid for that? And we have this honest discussion. And we feel that if the founding doctor or doctor senior is still going to do a significant amount of management responsibilities, they should get paid. And if the junior partner balks at that and says, okay, well, then let's go out and hire someone who's going to handle all the bookkeeping, who's going to handle the marketing. And the next thing you know, you might be spending $50,000, $60,000, $70,000. So again, we need to have this conversation. Sometimes it can be done on a percentage of gross receipts or percentage of profit. Nonetheless, it needs to be addressed. And of course, dispute resolution protocol. If there's a tie, we have to bring in negotiators or to make sure that third-party negotiators can come to a reasonable conclusion. Now, if a new partner leaves prematurely, and this is not for death or disability, but they decide they really don't want to be a partner anymore, or they have a good friend who has this great practice in Arizona, and they're in a northeast part of the country where it snows a lot, they may say, you know what, I think I'd rather go down there. I don't want to be a partner here anymore. And they go to the senior partner and say, I'm leaving. Should they get full value? Well, we feel that if a junior partner leaves voluntarily in the first 5 years, they shouldn't get 100% of their value because there's been considerable time and effort getting that person in the door, not only the expense of it, but just the everything that needs to be done to form it. There should be some type of a discount. So typically we use a sliding scale where if the partner leaves within a year or less, there is a much more significant discount than if they leave within 5 years. Again, there's no right or wrong answer. These things just need to be addressed and negotiated so that if this does happen, there is a way to settle it without having to get involved in any kind of litigation. And I've seen deals where if the junior partner really wanted the senior partner to be there for mentoring and other reasons, they may say, well, if you decide to leave in 2 or 3 years after we form this thing, I'm not going to give you 100% of value. So it can work both ways. Again, these things just need to be discussed and negotiated before you start drawing up the paperwork. If there is a partnership dissolution, particularly if there's a call center or there's multiple locations, phone numbers become a very important asset, as well as URLs for websites. We've seen battles occur over that. If there is a dissolution and you're a tenant, who remains in the facility? What happens to that junior partner? Will the landlord let them off the lease? So you need to just deal with those issues before you start dissolving things, because it could become costly. If the one partner owns the real estate, well, if they're going to stay, maybe there's some consideration of relocation expenses based on the reason for the dissolution. And what about staff retention? Do the partners want to have certain staff that they can retain? I've seen some agreements where doctors have written in the names of key dental assistants that if they leave, that person can come with them. So again, just throwing these ideas out to show you all the things you kind of have to think about when you're forming a partnership. Now, the buyout is where things can really get pretty tricky, and they need to be discussed at the outset, meaning when it's time for Dr. Senior to retire, are you, Dr. Junior, going to be required to buy out or just given a right of first refusal? So if you're in an area where there aren't as many doctors available, smaller town, you may want a required buyout versus, well, I'll get somebody else to come in and take my place. So you may consider some kind of liquidated damage so that if Dr. Junior doesn't buy you out, they have to pay a certain amount of money to you because you have to go through the process of trying to find someone to take your place. And that's a very difficult transaction. When we have to bring a third party in and the current junior partner doesn't want to buy the senior person out, it can get problematic. So we also have to create a formula for the buyout at the outset. And so just because you own 50% of a business doesn't mean you should get 50% of that value when you retire. We believe that if you've really slowed down, you're not violating your contract, but you're not as productive as you were in earlier years, maybe you shouldn't get the same amount that you would had you stayed as productive. So consequently, we take a look at the relative clinical production of a departing partner over a 3-year period, and we may adjust the value of the goodwill, which would mean some kind of discounting for the buyout value. And again, it's the old story. If you can cover these things in your agreements and discussions, you will avoid a lot of problems. And of course, if you're going to be retiring, are you going to remain as an employee, or is a new doctor going to replace you? And obviously, how are you going to get paid? Well, based on how you set up your structure, you may be limited on your buyout options. A lot of doctors would rather get cash. In some instances, based on the particular method you used for the buy-in, you may be put in a position where you have to consider deferred compensation. And deferred compensation means that you don't get a lump sum. You're going to be paid over time. Typically, with the deferred comp, there can't be a restrictive covenant for Dr. Senior, and so you can't prepay them. So again, we need to look at the second half of the buyout as critically as the buy-in, because we don't want to be negotiating these 10 or 15 years in the future. That could be very problematic. So, covered a lot of ground tonight, somewhat technical, but I hope that you have an understanding that partnerships can be very successful, but you've got to do a lot of hard work and heavy lifting and use the proper advisors to make sure you enter into this arrangement and you have a successful outcome. And of course, if you don't have a successful outcome in your partnership, if you've had properly designed agreements with ways to rectify issues, then things will be a lot better for all concerned. So I thank you for joining me this evening. If you'd like to learn more, you can visit our website at henryscheinppt.com, or you can email us at ppt@henryschein.com. So thank you, everyone, for joining us this evening, and I hope you found this time to be with me valuable to you. Thank you, and good night.
Thank you, Tom, for another excellent webinar. And as a thank you for attending, all attendees will receive the recording of this webinar via email sometime in the next week. For more Henry Schein webinars, visit henryscheindental.com/webinars for our upcoming schedule. Thanks for joining us. Have a great night.